Hey everyone, my name is Rohit and welcome to Valuable Direction. In this video, we're going to cover an important topic about new and young investors. We're going to talk about what they should know in the stock market and the mistakes they should avoid in such volatile times. To understand that, we need to go back to 2018. In 2018, the stock market crashed near about 20% because the Fed decided they will be raising interest rates. But in 2019, they changed their mind and kept the interest rate same. So over a period of 1 year, a lot of people made interesting gains. Then 2020 happened.
This is the 63rd day of this massive global health crisis.
Yeah, we are here tonight because of the violent market reaction to the very real threat the coronavirus is about to impact this country in ways we have never seen before.
Nervous investors prepare for more uncertainty.
The fastest correction the stock market has ever seen.
Oh, there will be more cases, there's no question.
You know, in 2020, the stock market crashed near about 30%. And it was chaos and panic all around. A lot of investors lost money due to panic selling or they lost their gains from the previous years. But to bring the economy out of recession, the Fed decided to reduce the interest rates next to zero and injected more money into the economy. Then over a period of 18 months, the stock market skyrocketed and nearly doubled from its lows of March 2020. Most of the gains were actually on the shoulders of tech giants and stay-at-home plays. Although the world was suffering, but the stock market was just going up. Anyone who have invested money in anything went up. Everybody was making money in stock market and crypto.
Out there for investors to weigh as well, as we are on record high watch here. Bitcoin flirting with that as it moves past. It's come back down a little bit from that $66,000 mark. Closing in on the all-time high there. It's the 66,930 level.
But in the last couple of months,
I think the risk of higher inflation has increased. So I think the word transitory, use it to mean that it won't leave a permanent mark in the form of higher inflation. I think it's probably a good time to retire that.
The Fed have decided they will be raising interest rates at a faster pace now. Even if the Nasdaq is at all-time highs, 40% of the major tech stock have lost their 50% of the valuation. All high valuation, small and mid caps and cryptos have been crushed badly now. A lot of retail investors are either losing money or they have lost the gains which were made in 2020 and 2021. So, as a new and young investor, this is at least you should consider and focus on simple ideas of investing. One of the key investing rules is timing the market is more important than timing the market. What we can learn from great and successful investors like Benjamin Graham, Warren Buffett, Charlie Munger and Peter Lynch, that you need to keep a long-term horizon for your investing goals. And if you look at the data, these successful investors, by investing from 10 to 50 years, they have produced returns of about 10 to 30% over and above the S&P 500, which is pretty good. These great investors with their fantastic returns to their clients have proved time in the market always beats timing the market. None of them had a crystal ball, but they kept it simple by investing in fundamentally good companies to get good returns.
You're making a terrible mistake if you stay out of a game that you think is going to be very good over time because you think you can pick a better time to enter it. I know what markets are going to do over a long period of time. They're going to go up. But in terms of what's going to happen in a day or a week or a month or a year even, I've never felt that I knew it and I've never felt it was important. I will say that in 10 or 20 or 30 years, I think stocks will be a lot higher than they are now.
So what does time in the market means? Time in the market simply means that you're trying to guess when is the market is at the lowest and when the market is at the highest. While timing the market means you're trying to buy a security with an expectation to sell it at a higher price in a short time. That is technically a bad thing and it does not produce good results. If you look at this 100 year of historical data, and if you're trying to guess this is the low and this is the high of the market, you would have missed the great returns for all the years ahead. If you're trying to time the market and you bought the stock at this point expecting it to only go up in short time, you might end up panic selling in a stock market correction or a crash. That is why timing the market is very inefficient strategy.
You don't have to mix investing with trading.
The question arises for how long you should be investing. Technically, as long as possible till it meets your expectation or something has changed fundamentally with the company. In general, 7 to 10 years is a good time frame to invest, but it is still not foolproof. Because market irons out a lot of fluctuation and businesses grow over time. And if you look at this chart, over a period of 10 years, stock market gave returns nearly 300% compared to bonds, cash and commodities, but it also had its fluctuations. So what matters if not timing the market? To understand that, we need to meet our friends John and Vic. John and Vic decided to invest in stock market after the financial crisis of 2008. They both decided to invest for 10 to 15 years. John decided to invest in Apple, whereas Vic picked the famous or the hype stock of that time. John started with the psychology that buying a stock is like owning a business, and a business he can understand. He was himself a consumer of Apple product. He noticed people are using Apple products all around him. Everybody seems to like and wanted to own one. He even tried to realize that Apple is innovative with their products and they're trying to meet the consumer demands. He went ahead and started following Apple's earnings and observed the company's revenues are increasing. He visualized Apple can have strong growth in future because of the great fundamentals the company is built on. Whereas our friend Vic has done no analysis of any sort. John just followed his plan. He avoided all sorts of noises from people and news. That's basically were market fluctuations due to various events over the years. He also had a no sell button logic. That means his focus was on increasing the quantity of his shares whenever market presented an opportunity.
The best thing with stocks actually is to buy them consistently over time. You want to spread the risk as far as the specific companies you're in by owning a diversified group, and you diversify over time by buying this month, next month, the year after the year.
Vic, on the other hand, kept changing his mind because of the distraction from media and talking to people who are themselves clueless about investing or got excited with the short-term gains or panic selling.
Some people should not own stocks at all because they just get too upset with price fluctuations. If you're going to do dumb things because your stock goes down, you shouldn't own a stock at all.
He was on a roller coaster market emotion and was buying and selling many stocks without any logical reasoning. His focus began to build on short-term highs and lows of the market. So by 2021, John Apple investment generated massive returns of 2,400%, while Vic ended up having miserable returns, and some of the speculative investments caused complete loss of his capital. Now you have to decide, do you follow the psychology that John followed, or do you want to do what Vic did, or you want to learn from his mistakes? So as an investor, you need to understand the risk in the stock market. One of the major risks in the stock market is crash. Stock market crashes are common. If one wants to understand the data, you can easily see that in the last 100 years, the stock market crashes for a sum of 6 years. The percentage of the crash was from 75% during the Great Depression to 30% during the coronavirus crash. In between that, there were wars, various world events, dot-com bubble crash, or a financial crash of 2008. Those were the reasons for the crash as well. This is why investing can be a roller coaster ride, because you don't want to see your investments going down. If you end up investing in fundamentally bad companies, you might lose all your investment. Some young investors take debt. That means they end up buying stocks in margin, and when the stock market corrects itself, they end up losing all their money. It is not advisable to buy stocks on margin if you don't know how to manage the risk of margin. If you look at this chart, there were times where the market was just recovering from a major crash, or for a lot of years it did not produce any significant returns, or it has crazy swings for years stretched. Since we covered up the risk, now we're going to talk about what are the odds in your favor while investing in stock market. From this chart, we can see market produces variable returns, but over the last 196 years, 70% of the times stock gives positive returns and negative only 29%. There were times in the market when the stock generated minus 30 to minus 10% returns, whereas a lot of times it generated from plus 10 to plus 50% of the returns. But on an average, market produces 10 to 13% of average returns. That is why the odds are definitely in your favor. And with this 10 to 13% of average returns, the power of compounding works for you. Because we know good businesses mature over time and generate earnings. So hypothetically, if someone's great-grandfather invested $1,000, it would have converted into over $1 million by 2014, which is way more than even government bonds and bills. Even gold is left behind because these values are inflation adjusted.
If you save money, you can buy bonds, you can buy a farm, you can buy an apartment house, or you can buy a part of American business. And if you buy a 10-year bond now, you're paying over 40 times earnings for something whose earnings can't grow. And you compare that to buying equities, good businesses, I don't think there's any comparison.
So should you invest in stock market?
I don't know when to buy stocks, but I know whether to buy stocks.
First, you should consider investing in property because it's a great inflation hedge and it helps you to save on taxes. And you can also even rent your property to generate some passive income. The next thing, you need to make sure that the money you're investing, you don't need for 7 to 10 years. As you know, the market's going to be going up and down. Your short-term need might force you to panic sell in a bear market. The last thing you should consider using that money to develop a talent. From that talent, you can generate some passive or primary income. It is actually investing in your own capability and probably in your own business. But if the answer is no to the above discussed point and there is nothing that needs your investment, then you should definitely consider investing in stock market. So in conclusion, as a new and young investor, if you already have a good psychology of investing, keep up the good work. Even if you had made mistakes in the past, it's important to learn from them. The idea is you can be a successful investor if you understand the psychology of investing, and with the proper risk management, you can grow your wealth. I hope you got some good info and direction from this video. If you got some value, please like and subscribe to the channel because there's more for you in the upcoming videos. Thanks for watching. See you in the next one.